A stronger than expected economic report, and the Fed makes no move on interest rates. Senior Director of Government Affairs for the National Taxpayers Union, Thomas Aiello, joining us. It's great to see you. So let's begin with the GDP, which surged in the second quarter, according to new numbers. Many experts surprised by this, Thomas. With the potential for higher tariffs from some of the world's largest economies come Friday, do you think that this trend will continue?
Yeah, digging through the report, there's only one word to describe it, and it's kooky, because the top lines are really great. 3% GDP growth for the year, consumer spending still up, exports still strong. But really, when you get into the details of it, there's some concerns that I think the Fed is looking at as well. You had domestic investment decline. You had small businesses inventories, the goods that they have in their warehouses decline. And then we also had the slowest growth for consumer spending since the middle of 2022. So there's a lot to look at. I'm hopeful that as more of these trade deals come in, it'll give small businesses, big businesses, and the Fed a little bit more certainty to decide what they want to do as they look ahead to a rate cut in September.
And that really leads to my next question. We mentioned the Fed kept interest rates unchanged. There's been speculation about a potential cut in September. So why not now? What is the Fed really looking at?
Yeah, it is really puzzling that they decided not to cut interest rates. I think they're concerned that the tariffs were going to lead to inflation. We just haven't seen that in the data yet, which is kind of surprising, which is something we would have expected. But even if you were to cut interest rates by about 25 to 50 basis points, lowering the rate to about 4%, it's not like we're going to have the same levels of inflation that we had under the Biden administration. What I'm thinking is the Fed needed to show their independence from the administration, that they have some resolve, and they weren't going to cut rates, which is what the president wanted. Now, I think if we were to cut rates, which I think the Fed should have done this time around, it would lower borrowing costs for, building and getting a mortgage, and most importantly for our national debt and the money we borrow, we'd be able to do that at a lower rate. So I am a little surprised they decided not to.
When you talk about independence, so are you talking about, in your opinion, this was about messaging?
I think that might be part of it, but the Fed is looking at a couple of different indicators. I think they wanted to see another jobs report. They wanted to see another inflation report before they decided to make their decision. The Fed, they don't look at things on a 1-month basis. That's just a data point. Right. 2 months and 3 months, it becomes a trend. And that's what the Fed looks at. Is it trending towards more inflation or less inflation? And is the economy cooling or staying strong as it is now? So they take all of those factors into account.
Got about 30 seconds. What are your expectations for Friday's jobs report?
They're expecting 100,000 jobs. That's been stronger than expected over the past couple of months. I'm hopeful that we'll see strong job growth, and with the certainty from the tax cuts plus the tariff deals, trade deals, I'm hopeful we'll see expanded job growth through the rest of the year.
Yeah, we'll see if that strengthens the case for a potential cut come September. Thomas Aiello, thank you for joining us tonight on the National News Desk.
Thank you.